Bismillah ar-Rahman ar-Rahim. Today, inshallah, we have the most important lecture for financial ratios. Today, inshallah, we will finalize everything related to the financial ratios. As you may remember, we finished together how can we calculate and evaluate the liquidity ratios. How can we calculate and evaluate the performance of the company related to the financial leverage, which is, we can call it long-term solvency, or we can call it debt ratio. And also, we evaluate the asset management turnover ratio, or sometimes we call it efficiency ratios. Today, inshallah, we will finish together the profitability ratios and the market value. This group, the last one, this only for the company listed on the stock market. So please, highly concentrate today, inshallah, for the profitability ratio. Inshallah, today, we have about 8 ratios, all related to calculating the profitability ratio. First one, we can call it profit margin. This is the profitability ratio. And the first one, we call it profit margin. What is the profit margin? Profit margin equal net income divided by sales. Okay, to just imagine what is the importance of the profit margin. This is the sales or revenue, and we deduct the whole cost, and the residual is the net income. Assume we have net income equal 100 and our sales it was 1,000. Profit margin equal net income divided by sales, which equal 10%. This means that our cost represent 90% from our total sales. Okay. Now, for each $1,000 as sales, we generate $100 as a net profit. Is this good or bad? We have to compare with our competitors, or we have to compare it with the previous year. Okay. If we need to improve this ratio, how can we improve this ratio? Because the higher the profit margin, the good the profitability for the company. How can we improve this one? We have two ways. By increasing the sales with maintain the cost, so this one will be improved. Or, because to increase the sales is not easy. So what you can do, you can control the cost. You can reduce the cost. So we can increase this one by reducing or controlling the cost, and this is the optimal way to improve the profit margin. Okay. In our company, our profit margin, it was 3.6%. What this means? For each $100 sales, we generate a profit equal $3.6. Is this good or bad? Fortunately, that our competitors, they have the same ratio. And we are dealing with a very competitive market, and this is why we cannot make a very high profit margin. Okay. But how can we increase? Because increasing this one, it means a lot for the company. Because if you have this one as a 10%, and the competitors, okay, just imagine this one. Now, you have a ratio equal 10%. This is a profit margin. our profit margin. If the rest of the competitor in the industry, this ratio is 20%. In this case, because our company has just 10%, it is in a very bad situation. Why? Because anyone from the competitors, he can push me out from the market. How? If he just reduce the price by 15%, it's okay. From where we get this 10%? This is the difference between 1,000 and 100, so we have a cost equal 900. This is why we have this one. Okay. The industry or the competitors, from each 1,000, they have a profit equal 200. This is why they have a ratio equal 20%. If this one, he need to push me out from the market, what he can do? He can, this means what? This means that our cost equal 80. But in my company, my cost equal 90%. Okay, or 900. And this one has cost 80% or 800. If this one, our competitors do, they need to push me out from the market. What he can do? He can reduce the price to be 850. In this case, he will make a profit equal 50. But for me, I have also to reduce the price. If I reduce the price to be equal 850 and my cost is 900, so in this case I have a loss equal 50. By time I can't continue. So in this case I will go out from the market. So the higher the profit margin, the higher the competence you can make. And you will have a high ability to reduce your price without affecting. تاني، كل الريشيو دي ما تزيد، قدرتك على المنافسة بتزيد، وقدرتك على تخفيض السعر وانك تقدر تستمر بتبقى عالية جدا. لذلك في الحقيقة السوبر ماركت الكبيرة عشان الكوست بتاعته قليلة هو يقدر يخفض السعر ويستمر. السوبر ماركت الصغير ما يقدرش يعمل كده. لذلك تلاحظ ايه لما بدأ كارفور، فتح الله، السوبر ماركت الكبيرة اللي موجودة عندنا، ده أدى في الحقيقة إلى إغلاق سوبر ماركت كتيرة صغيرة، لأن دول عنده البروفيت مارجن عالي فيقدر يخفض الأسعار من غير ما يطلع من السوق. طيب دي أول ريشيو احنا عاوزين نفتكرها اللي هي البروفيت مارجن. أوكي، الريشيو الثاني في الحقيقة عندنا مهمة جدا اللي هي return on assets. Return on assets, ROA. You will never hear return on assets. Always they will call it, what is your company ROA? Return on assets. By Arabic العائد على الأصول. Sorry, profit margin. هامش الربح. Return on assets equal net income divided by total assets. Okay. In our company, the return on assets, net income from the income statement, total asset from the balance sheet, it is equal 7.3%. And in the industry, it is equal 9%. What does it mean? It means from each $100 invested on assets, we generate 3.7 as a net income. But in our competitors, from each $100 invested on assets, they generate $9 as a net profit. This means that the competitors, they are more efficient than us to generate a profit from their assets. Okay. For sure, the higher the net income, the higher the ROA, the better for the company. From ROA, we can calculate something, we call it earning power, القوة الإرادية. Remember when we talk about asset management, remember when we talk about the turnover, معدل الدوران, we can consider the turnover as a trip, رحلة. So the more the turnover, the more the profit. Why? Because in each one turnover, you generate a small profit. So by increasing the turnover, by the end, you will have a very high profit. This is why we can calculate the earning power, which is the ROA, by using the idea of the turnover. هنا في الحقيقة أنا عاوز أعمل معاك إيه؟ We need to learn how can we recalculate the ROA using another equation. ROA, another equation, we can calculate. Don't forget, huh? ROA equal TAT2, which is total asset turnover, remember last lecture, multiply the profit margin, the one we just calculate now. So TAT2, total asset turnover, any turnover, we have sales or revenue divided by total assets, multiply profit margin, which is net income divided by sales. If we cancel the sales, multiply sales with sales, it will be what? Net income divided by mean total asset, which is what? Which is ROA. The idea with this equation that we can separate our ROA from where we have. This is the normal one, which is net income divided by total sales, but this gives you a number. And because we are lower than the industry, so we need to know where is the problem. Is our problem from the turnover or our problem from the profit margin? If you still remember, we don't have a problem for profit margin. Why? Because our profit margin, it is the same as the company. So we don't have a problem with profit margin. So from where we get the problem? We have the problem from the total asset turnover. Remember? If we go back to the total asset turnover, which is this one, remember? From here we have the problem. Our total asset turnover, which is 2, and the company has 2.5. So this is why we have return on assets 7.3, and our competitors, they have 9%. Why? Because this is the 2 multiply profit margin. This is give me ROA. From the beginning, I know from my company 7.3, and the competitors or the industry 9%. This comes from where? This is the 2 from my company. 2% multiply 3.6%. This is give me 3.3 because this is a small fraction. Okay, but for the competitors, they have 2.5 multiply 3.6%. So now, as a financial analyst, you can give a very good recommendation that our ROA, which is 7.3, is lower than the competitors, not because our pricing system, not because our profit margin, but this is because the marketing. This is because we have a lower total asset turnover. Okay? This is how can we make a relation between the ratio from different groups. Okay. This is ROA. So now we just calculate two ratios, profit margin, ROA, and we calculate ROA by two ways. By the normal one, ROA, or by earning power, اللي هو القوة الإرادية. And we know from the earning power that the ROA is lower because we have a problem for efficiency of our assets, or we don't use our assets in an optimal way. This is why you have a lower TAC2 or a lower total asset turnover. Okay. The most important ratio, we call it ROE. Please don't forget. We have profit margin, we have ROA, we have ROE. ROE, which is return on equity. By Arabic, العائد على أموال الملاك. This is the most important ratio. Return on equity, ROE. You will never hear return on equity. Always they said, what is the ROE in your company? So you have to know that ROE, we call it return on equity, which is العائد للملاك. ملاك اللي هيشتغلوا عندك، اللي هيساهموا في الشركة بتاعتك بياخدوا عائد كام. This is the most important one. Even the whole 5 groups, we can summarize them only in ROE. Again, you can go to the bank and ask for loan because you have a higher, and the bank will accept to give you loan because you have a higher ROE. The most important ratio. So ROE equal net income divided by total equity. Okay. If you are smart enough, when ROE equal ROA, I can hear you. This only if, this is to know, this is our assets, this is our liabilities and equity. If the assets equal 1,000 and this is 1,000, if the company has 0 debt and financed totally by equity, so in this case, our equity equal 1,000. So this is the only situation that ROE equal ROA. So if ROE equal ROA, one of the reasons that the company financed totally by equity and has no debt. And as we mentioned before, this is the situation for the business family. Okay. But if it is higher, if ROE higher than ROA, this means that our equity is lower than the assets, and this is happened only if we have a positive value for the debt. Okay. It can be lower? Yes, it can be. When? I will tell you now. Okay. So our return on equity, please remember, our return on equity, net income divided by total equity, in our company 16.3%, which means each $100 contributed by the owner, they generate $16.3 as a profit. At the same time, in the industry, our competitors, each $100 contributed by the owner, they generate $18. So our company gave a compensation for our owners lower than what they receive from the other companies. Okay. Now we need to investigate why we are lower. But please don't forget that our return on assets, remember this one? Our return on assets, which is this one, remember it was how much? 7.3. But our return on equity, 16.3, more than the double. Why? What happened? Oh, for sure we have debt, because our return on equity higher than this one. It means we have debt. Okay. And as you see, return on assets here equal 9% for the competitors, and return on equity equal 18%, which is double. Okay. Why they have this one? Okay, this one, what we have to talk about. Okay. I will come back again to return on equity, the most important ratio. But before this one, I need to explain another ratio, which should be number 4, this one. We call it return on investment. Return on investment. Normally we call it ROI, which equal, not net income in this case, it is equal EBIT. Remember what is EBIT? Earning before interest and tax divided by working assets, or we call it, yes, net assets, not total assets. What I mean, we have to exclude from this one any non-working assets. Sometimes we can find on our assets some assets, we call it under construction. Like what? If we have buildings, this is assets. Land, the building, we can consider it assets, so it is a total assets. But this type of asset, it is not working yet. We don't use it to generate the profit we have now. So we have to exclude these assets from our net total assets. We have to exclude this one. This is why we have something we call it return on investment, ROI. This is a very important ratio. Okay. Return. Okay. So now we have 4 ratios. We have profit margin, we have return on assets, return on equity, return on investment. Okay. I will go back again to return on equity. As I mentioned before, this is the most important ratio. So we have to understand this ratio by many different ways. So please highly concentrate. This is, we can consider it number 5. Return on equity. Using something we call it Dividend analysis. What is Dividend analysis? Dividend analysis, it's for only for analyze from where we have the ROE. Okay. Depot company. It's a very huge company, and the financial manager. He is not a professor. The financial manager of this company developed this analysis, and long time ago, and until now, we use his analysis to explain it to the student. I will explain from where he get his equation in details, just to know how can we improve. As a student, you can generate and improve your own ratios. Okay. What is ROE? ROE equal net income divided by total equity. In your opinion, is any problem for this equation to be multiplied by 1 over 1? For sure has no problem. Okay. Instead of 1 divided by 1, is any problem to make it multiply by total asset divided by total assets? Has no problem. So we can get another equation to calculate the ROE from this one by making net income divided by, mathematically has no problem to shift this one instead of this one. So it will be net income divided by total assets multiplied by total assets divided by total equity. So this is the second equation. So the first equation, ROE, this is the normal one. Second equation for calculating the ROE by, take this one, this is, as you may remember, this is the ROA, multiply, I wish you still remember this one. Yes, this is the equity multiplier. Equity multiplier. So now, the second equation for calculating ROE according to the Depot analysis, that ROE equal ROA multiply equity multiplier. And as you may remember, if the company financed totally by equity and has no debt, remember, in this case, equity multiplier equal 1. So, in this case, ROE equal what? Equal ROA. Okay. So, this is the second equation according to Depot analysis. From Depot analysis, he also continue his mathematical analysis by multiply this ratio, multiply 1 over 1. And 1 over 1 in this case will be sales divided by sales. So the whole picture, that ROE equal return on assets multiply equity multiplier multiply sales divided by sales. We can replace this sales instead of total asset and total asset instead of sales. So it will be the last one, that ROE equal net income divided by sales multiplied by total or equity multiplier, total asset divided by total equity multiplied by total assets, sales divided by total assets. Okay. You have to know that this long equation gives you the same old one, net income divided by total equity. If you take this sales with this sales and this total assets with total assets, so we have one, we have net income divided by what? Total equity. So this is right. You can add as much as you can. you can multiply fixed asset divided by fixed assets and continue. So you can add whatever you want to make, to calculate his contribution for return on equity. This one, which is number 3, this is the Dupont analysis. So when you hear calculate ROE using the Dupont analysis, you have to use this equation. This one also we can consider it as apart from Dupont, but normally we use this one as a ratios using to calculate the return on equity. Okay, to understand the idea, if we have two companies, and the two companies, they have ROE equal 25%. In this case, if you don't understand what we mean by financial analysis, you can consider that the two companies, they have the same ROE. But using Dupont analysis, which give you more view, ROE equal what? Equal profit margin multiplied by, because this is a profit margin, multiply equity multiplier, multiply the total asset turnover. So profit margin multiply equity multiplier, multiply the 2. By analyze company A ROE, we found that the profit margin, it was 5%, equity multiplier, it was 5, total asset turnover equal 1, so 1 multiply 5 multiply 5% give me 25%. Company B, which has also ROE equal 25, but it has 10% profit margin, it has 1 equity multiplier, it has 2.5 tattoo. Now, using this information from Dupont, which company is better to invest in? You have to invest, you have to recommend to invest in A or B, with taking in consideration that the ROE in company A and B equal 25%. Okay. How can we know? By comparing the profit margin in the two companies and comparing the equity multiplier in two companies and comparing the total asset turnover in the two companies. For sure, in my opinion, we have to accept to invest in company B. Why? Because company B has a higher profit margin than company A, which means from each $100 sales, company B generate $10 as a net profit, when company A generate only $5 as a net profit. Also, company B has no risk at all because it is totally financed by equity and it has no debt. But this one, it is financed by 20% from equity and 80% from debt. Very high ratio, which means a very high risk. Also, company B is better than company A because it has 2.5 turnover for assets and this has only 1 turnover. So this is why we recommend to invest in company B instead of company A. We cannot know this information without Dupont analysis. Okay? For our example, by recalculating the ROE using the Dupont analysis, it will be like this. As you may remember, this is the This is the ROE by net income divided by equity, and this is the profit margin multiply that to total asset turnover, and this is the equity multiplier. You can discover that we have 16.3. There is no difference between the profit margin between our company and the competitors, and we have a lower total asset turnover, but we compensate this by increasing the equity multiplier. So in this case, even the 16.3% as ROE is not real, because this we have it by increasing the risk, by increasing rely on debt. Okay. Now we are going to recalculate the return on equity by using a very important equation. So we can consider this as, we can call it by using EVA, economic value added. Economic value added. This one, in my opinion, the most important equation. You will never find it somewhere else. So please highly concentrate. Now, we are going to recalculate the ROE using EVA. ROE equal ROI, return on investment. Remember, return on investment plus ROI, return on investment, minus interest rate. This is multiplied by total debt divided by total equity. A very important ratio. Okay. Please don't forget that you have to know this is before tax. This ratio before tax. If we need it after tax, I have to multiply all of those, multiply 1 minus tax rate. So this is 1 minus tax rate. So this is give me ROE after tax. Okay. Now, how can I calculate this for any company? This is already we have it. Even this ratio we have. How can we calculate the tax rate for the company? And how can we calculate the interest rate for the company? Okay. Tax rate, you can calculate it like this. Tax rate equal the tax you pay, tax paid, divided by earning before tax. By calculating this one, you will get the tax rate, how much you pay as a tax for your company. In this case, we have to go back to the income statement. If you go back to the income statement, okay, this one. This is the tax paid, 235,584, 253,584 divided by earning before tax. It was 633 960. You calculate this one, you will get the tax rate. Okay? How can we get, shortly we'll calculate this one, how can we calculate the interest rate? To get the interest rate, you have to know that the interest we pay, this is because we have debt. So to get the interest rate you already paid, you have to get the interest paid فوائد اللي انت دفعتها divided by total debt. In our example, the interest paid 120,000 divided by the total debt. Remember, the total debt we have to get it from the balance sheet. Our total debt, it was here. Okay, someone else, okay. Tax rate is exactly as we have mentioned, it is 40%. Interest rate, it will be 120,000 divided by total debt. In this case, I will get the interest rate. Okay, in this case, this is ROE 1 minus 40% multiplied by ROI. We calculate the ROI before. ROI was here. Return. Yes, this is the one. Okay, might be we don't have it. Okay, ROI. We have to calculate our ROI. But we have it.
50.
Okay. ROI, it was EBIT divided by total assets. So ROI, it was 14.37% plus ROI 14.37% minus interest rate. No, I need interest rate. By calculating interest rate, it was 4 point. Please, you have to calculate it by yourself. It is 120,000 divided by the total debt. You have it before. So it is 4.11%. Okay? So the interest rate 4.11% multiplied by total debt divided by total equity. We have this ratio before. It was 1.25. Okay. Without calculation, if I multiply those, I will get exactly 16.3%. Please, you have to try at home. Now, the unique information you have from this one, you have to know what? You have to know that this one, we call it trading equity. Trading equity by Arabic المتاجرة بالملكية. Which means what? Which means we use our creditors and we get the money from them to invest for our owners. This is why you don't need to pay everything from your pocket as an owner. You can use loans, you can use debt, but you have to know what? You have to know you are in the right position only if ROI, the return on investment, greater than the interest rate. In this case, you are an excellent investor if you take a loan and you invest the loan and you generate a profit from the loan higher than the interest rate. In this case, by increasing your rely on loans, you will increase the return on equity. This is why for your country at home, we have no problem if we increase the debt, as long as we invest the loan, we take it from outside or internal loan. If we invest these loans in investment and we generate a profit higher than the interest rate. In this case, we have a positive effect of loans. The problem we will have only if the return on investment lower than the interest rate. This is the main problem. So, for any company, for the whole countries, we have no problem for loans as long as we take the loan and invest the loan in a project or investment and generate a profit higher than the interest rate. Again, the problem raised if this one greater than the return on investment. Okay, so if I asked you, do you have a loan positive effect? Only you can compare this one with the interest rate. Compare the ROI with the interest rate. If this is greater, we have a positive effect to loan. If the ROI lower than the interest rate, we have a negative effect of loan. If it is equal, you have no effect of loans. So again, in this case, we have 16.3 and we can increase it to be higher if we rely more in loans by increasing the total debt to total equity. Let me talk to you. Japan as a country, they increase this ratio to be 3.2. The whole country, the Japanese country. Japan country, they increase this one to be 3.2. Why they make it like this? Because they reduce the interest to be approximately zero. So any return on investment will be higher than this one. So by increasing the total debt to the GDP, they increase the whole return on equity for Japan country. Also, in Egypt, we have this ratio now, it becomes 85%. We reduce it from 1.07 to be 85. I'm not happy by declining this ratio. We have no problem to increase it back, even to B2, no problem, as long as our return on investment greater than the interest rate we pay. Okay? So we can use this one for a company, or you can use it for the whole country to see what you have, what is the effect of the total debt. Okay. So you have to know now that we have 3 ways to calculate the ROE. One, simple equation. Second one, deep-bone analysis. Third one, by EVA. And the EVA help us to know what is the effect of that. Okay? Okay. Now we have more 2 ratios for the profitability ratios. We have internal growth rate. This one, it should be ratio number 7, something like that. Internal growth rate. internal growth rate normally we call it IGR معدل النمو الداخلي. Internal growth rate equal ROA multiply by retention ratio نسبة الأرباح المحتجزة or multiply 1 minus dividends ratio. Dividends ratio نسبة التوزيعات. Because if we have 200 million as a net income, what you have to do, you have to distribute part of them as a dividends, توزيعات, and you have to take the rest as a retained earning, أرباح محفوظة. So, if we distribute 80 million, which means I will take 120 to be reinvested for the next year. This is the retained earning. If I need to calculate the dividends ratio, it will take this one, dividends ratio. It can be calculated like this. Total dividends divided by net income. Total dividends 80 divided by net income, which is 80 divided 200, it is 40%. Without calculating the retention ratio or retained earning ratio, it will be without calculating, it will be how much? 60%, which is 1 minus 40%. This is why we call it retention ratio. Okay. Internal growth rate, in our case, remember, ROI. ROA, it was 7.3%, as I remember, multiply by 1 minus dividends ratio. 1 minus dividends ratio. We have to go back to our income statement to see how much the dividends we have. It could be total dividends or it could be dividends per share, we can see. Okay. This is the dividends per share, 0.22. And this is the earning per share, which is 1.14. Okay. Earning per share equal what? Equal net income divided by number of shares. Dividends per share equal total dividends divided by number of shares. So, if this is the information we have, easy to get the dividends ratio, not by divided total dividends by net income, but you can calculate it by dividends per share divided by earning per share. So we have two ways to calculate the dividends ratio. By taking total dividends divided by net income, this is one, if you have this information, or by taking dividends per share divided by earning per share. In our case, dividends ratio, it will be 0.22. Dividends ratio equal 0.22 divided by earning per share 1.14. It is equal 0.22 0.22 divided by 1.14. Okay. Equal 19.3%. Okay. So in this case, the retention ratio, it will be 80.7%. This is the retention ratio, the earning ratio. Okay. So in our case, if we need the internal growth rate, it will be like this. In our case, ROA 7.3% multiplied by 1 minus dividend ratio, and dividend ratio it was 19.3%. So internal growth rate will be 0.073 multiplied by 0.807, which equal
0.0589.
8.9. Okay. Approximately 0.05. This means approximately this is 6%. This is approximately 6%. What does it mean? That your company has internal growth rate equal 6%. This means that our company can grow by 6% without any external sources. Again, internal growth rate means by how much your company can grow without any external sources. بالعربي شركتك ممكن تكبر بنسبة كام بدون ما تحتاج أي تمويل خارجي. تمويل خارجي يعني إيه؟ يعني لا أسهم جديدة من الملاك ولا قروض جديدة من الدائنين. نمو ذاتي organic growth. تنمو بقد إيه؟ ب 6%. By explanation, remember that our company before, if this 100, which means 100%, and this is the assets, and this is liabilities and the equity, for sure this is will be 100. If you remember that we have a ratio of total debt to total assets. If we go to our analysis, this is how can we be as a financial analyst. Okay, we have, remember this ratio? Remember the total debt ratio, total debt to total assets. This asset, if it is 100, we use money from the debitor, from the creditor, equal 56. And for sure, in this case, the contribution from the owner, it will be how much? It will be 44. Please don't forget, this is the original situation. Now, because we have a profit, and our profit, we didn't distribute it 100%, we just distribute approximately 20%. So our assets can grow internally by how much? By 6%. What this means? This means that next year our assets, it will not be 100, it will be 106. Why? Because from internal growth rate, we know that we will grow by 6%. So for sure, in this case, our liabilities and the equity also will be how much? 106. Okay? But the definition of internal growth rate, that we will not use any external money. So our total debt, we will not have extra loan, so it will be 59. So our equity will be the remainder. In this case, our equity, it will be how much? It will be 50. It will be this one 67. How much? 40. 47. I mean, yeah, 47. So our debt, our equity will be how much? Will be 47. This is the summation of those. Will be how much? Will be 106. Okay. But this increase in equity, it will not by issuing shares. مفيش external. So it is from where? It is from the return earning. Because we have a return earning, we add it to this one. So this is our, I think this is 56. So yeah, this is 56. And this one, it will be 50. 44 plus 6 will be 50, so the summation 106. Okay. This is the situation of the balance sheet next year without using any external sources. So we highly recommend to any company, please, if you have net income, don't distribute your income for the owners. Don't distribute the whole net income. You have to keep something to be reinvested if you need to grow. Okay. We have another ratio. We call it sustainable growth rate. Sustainable growth rate معدل النمو المستدام. Sustainable growth rate. The only change in this equation, it will be instead of ROA, it will be ROE. So sustainable growth rate equal ROE multiply 1 minus dividends ratio. Remember, I think the ROE we have, it was 16.3%. This one, so you can rewrite it like this one. It will be 0.163 multiply 1 minus 0.193. So it will be how much? 13%. What this means? Highly concentrate, please, again. Internal growth rate, it was 6%, which means our assets can grow by 6% without any external sources. Don't forget external sources, without. Okay. What does it mean that sustainable growth rate 13%? It means our assets can grow by 13%. وصولنا ممكن تزيد ب 13% with maintaining the debt ratio. Again, our assets can grow by 13% by with maintaining مع المحافظة على نسبة الاقتراض. مش المحافظة على قيمة الاقتراض، المحافظة على نسبة الاقتراض. Which means, don't forget that from internal growth rate, our equity becomes 50. So this is 50. In this case, our total debt will be 63. 63 which means the summation will be 113. Again, what does it mean sustainable growth rate? Sustainable growth rate means that our assets can grow by 13% to increase from 100 to be 113 with maintaining the debt ratio. Maintaining the debt ratio, so in this case, if I calculate the total debt to total assets, it has to be 56% as it was before. In our case, if I take 63 divided by the new total assets, which means 113 without calculation must be 56% exactly that I was before. This is a very important two ratios. Internal growth rate, which means by how much I can grow without any internal, without any external sources. Sustainable growth rate, by how much we can grow by maintaining the debt ratio. بالعربي هو أنا ممكن أزيد قد إيه بس مع المحافظة على نسبة الاقتراض. ليه؟ لازم تبقى فاهم إن بعض البنوك لو لقت نسبة الاقتراض زادت عندك عن حد معين يمكن هيسلفوك. يبقى أنا بعمل إيه؟ بحافظ على نسبة الاقتراض. طب عشان أحافظ على نسبة الاقتراض لازم أعمل إيه؟ لما أزود الأصول يبقى الكباسيتي بتاعتي طاقتي الاقتراضية ممكن تزيد. طب تزيد إزاي؟ بإن أنا هرفع الاقتراض بس مش هتعدى النسبة اللي أنا كنت متفق معاها أو متفق على البنك عليها. دول مهمين جدا وأهم شيء فيهم إن أنت سيادتك يعني it's okay. I can ask you a question for the exam purpose. How can we increase the sustainable growth rate? ازاي نزود؟ دي نسبة عظيمة جدا. كل ما تزودها انت ممكن تزود اصولك بدون ما تخل بنسبة الاقتراض. How can we increase the sustainable growth rate? We can, sorry, from the equation. We can increase the sustainable growth rate by ايه؟ By increasing the ROE and decreasing the dividend ratio. لان انت كل ما تقلل دي نسبة الريتنشن هتزيد. يبقى احنا we have two ways. Increase this one and decrease the dividend ratio. As I mentioned before, McDonald's remained more than 25 years without dividends. وقعد 25 سنة ما يوزعش. عشان كده كان بينمو بمعدل سريع. لأن احنا بنلوم الشركات اللي الزملاء بيقولوا عليها إن احنا كل شوية كل ما يجي أرباح يوزعوها. طب هتكبر إزاي؟ مش ممكن تكبر. طيب يبقى احنا we can increase the sustainable growth rate by increasing ROE and decreasing the dividend ratio. أنا highly recommend instead of saying ROE you can say, because as you know ROE according to Dividend it's a profit margin multiply total asset turnover multiply by equity multiplier. يبقى عشان تقول كلام كويس قوي how can we increase the sustainable growth rate? By increasing the profit margin, by increasing the total asset turnover, by increasing the equity multiplier, and by decreasing the dividend ratio. دول الفور فاكتورز اللي يخلوا شركتك تبقى في السما. So again, what is the profitability ratio? We have profit margin, we have return on assets, return on equity, return on investment, and we recalculate again the return on equity using the Dividend and the return on equity using the EVA and internal growth rate and sustainable growth rate. These 8 ratios very, very important. Okay? The last group we have for today, just 2 ratios. We call it market ratios. And these ratios you have to calculate it for the company listed on the stock market because the information we need to calculate this ratio must be from the stock market. We have only two ratios must be announced, in my opinion, from the stock market itself. Number one, so now this is the fifth group, which is market ratios. نسب السوق. It means سوق المال يعني. First one, normally we call it BE. B means the market of the stock price. سعر السوق أو سعر السهم في السوق. E means earning per share. ربحية السهم الواحد. Very important ratio. Okay. If to understand what I mean, and remember this one we just calculated before, earning per share, normally we call it just E, equal net income divided by number of shares. صافي الربح مقسوم على عدد الأسهم. Okay. If the stock price on the market equal 800, so this is the P price, and the earning per share for the stock equal let me this okay, make this 80 and make this 4, and the earning per share equal 4. In this case, calculate the PE, the price earning ratio. The price earning ratio in this case, it will be 80 divided by 4 equal how much? Equal 20. 20 what? Normally we call it 20 times. What does it mean? That the BE ratio equal 20. It means if I bought this stock by $80 and the stock gave me, the company generate a profit equal $4 a year, it means I will get back my money after 20 years. So this is sometimes we can call it 20 years. And we can consider this one as the pay back, فترة الاسترداد. Again, BE equal the price divided by earning per share. If it is 20, it means I have to stay 20 years to get my money back, and the stock in this case will be free. And the rest of life, it means I didn't invest anything in stock, and the rest it will be a pure profit. If I asked you if this is a situation, what is the rate of return for this stock? The rate of return, easy, because we have the information. I invest 80 and I will get a profit equal 4. So 4 divided by 80, it is 5%. But normally, you don't have the component of the BE. Normally, they said what? BE equal 20. If I need to calculate the rate of return to get it from the BE, rate of return equal 1 divided the BE ratio, which equal 1 divided by 20, which is what? 5%. So it is very important before you buy the stock to know what is the PE for this stock. And by knowing the PE of the stock, you can calculate the return or the rate of return of the stock by taking 1 divided by the PE. My question, can we calculate the PE for the whole Egyptian stock market? As you may remember, how many companies listed in the Egyptian stock market? 2009 or 2007? Okay. In this case, you have to calculate the PE for each company. And by the end, you will get the average. Okay. The average PE for the Egyptian stock market around 15 times. The average around 15 times. So, if you know that the Egyptian stock market PE equal 15, we can call it 15 years, we can call it 15 times, as you like. Now, if I asked you what is your rate of return if you invest in the Egyptian stock market, how can, so the Egyptian stock market rate of return equal 1 divided by 15, about 7%. So, my question to you, if you know that I'm talking to you as a portfolio manager, and you have $1 billion, and you have ability to invest in USA, you have the ability to invest in wherever in the world. Do you think it is worth to you to invest in the Egyptian stock market? Again, the Egyptian stock market rate of return on average 7%. Bank has no risk. Stock market has a very high risk. If you deposit your money in the bank, you will get 12%. This is without risk. If you invest in the stock market, you will generate 7% with high risk. So, our stock market will go down and down because we have a very high interest rate in the bank. It is not recommended. I just mentioned a few times ago that Japan has 0 interest rate. Sometimes it has a negative interest rate. So they push people to invest in the stock market. By the way, today they announced that the Nikkei, which is a Japanese stock market index, raised up with the highest top from 30 years ago. المؤشر بتاع نيكي الياباني النهارده اعلنوا النهارده اللي هو شوف بقى احنا في 9 نوفمبر 2020 النهارده اعلنوا ان هو وصل لقمه لم يصل اليها من 30 سنه من قبل. ليه؟ عندهم ريت اوف ريتيرن والانترست ريت 0، فكله بيستثمر فين؟ بيستثمر في الستوك ماركت بتاعه. So BI or BE ratio is a very important ratio. So which one, if you know from the 209 companies or 207 companies listed in the stock market, if you know the BE ratio for each one, which one you have to select? I have to select to invest in the lowest one. أصغر واحدة هي دي اللي أروح لها. لأن أصغر واحدة it means I will get okay. If we have company A, company B, and company A has a price equal 100, company B has a price equal 150, but earning per share for company A, it has 8, for company B it has 30. In this case, we have to calculate the PE ratio. 100 divided by 8, it is 12.5. Second one, it is 5. Which one I have to invest in? B, because I will get my money back after 5 years only, and the rate of return, it will be 20%, 1 divided by 5. This one I will get my money back after 12.5 years, and my rate of return is 1 divided by 12.5, which is 8%. So the lower PE, the better the stock. Okay? Last one, last equation. We have for today and for the whole financial ratio, we also very important one is the price to book value. Market price to book value. Or sometimes, normally you call it like this. Price, stock price divided by the book value, or sometimes you call it market value to book value. Both are true. Market price, the market in the stock market. The stock price on the market. Book value, how can we calculate the book value? Book value, you have to take the total equity divided by number of shares. Total equity divided by number of shares. To understand the idea, normally the book value we consider it as the fair value, قيمة العادلة بتاعتها. يعني. And the market value, sometimes it is higher than the book value, and sometimes it is lower than the book value. If it is 1, if this ratio, market price to book value equal 1, it means that the market price equals the book value. What is the book value? Book value, to understand the idea, this is our total assets, equal 100. This is total liability and equity, must equal 100. This is current asset, fixed assets. This is total debt. This is total equity. And our total equity, 20 owners, 20 shares. If this one 40, this is 60. Okay. Assume this company liquidated, bankrupt, affluent. If the company bankrupt, we have to sell the assets and use the money to pay first the debt. So in this case, we will use the 100 assets and we will pay the debt which equal 40. So the remaining is 60. We will use it to be distributed to the owners. So each one, he has how much? This is what we call it book value. So book value equal total equity divided by number of shares. So it will be total equity 60 divided by number of shares 20. So it will be 3. So this 3, we call it the book value of the share. Okay? Sometimes the market price for this one, it is 5. Or sometimes we can sell it for just 1. According to what? According to the future of the company. If the company has a good future, the investor they are willing to pay a higher price. If it has very bad future, so they are willing to sell it for just $1. So the market price, it could be higher or lower according to what if the company promising or not. Okay. So, but you have to know that the amount of the book value represent the amount you will receive if the company bankrupt. البوك فاليو القيمة الدفترية ده المبلغ اللي انت هتستلمه لو الشركة أفلست. طيب. In this case, if we have two companies, A and B, the market value السهم في السوق هنا 120 هنا 400. The book value قيمة السهم في الدفاتر هنا 240 هنا 100. If we calculate the market value to book value, and this one it is half, and this one equal 4. Which company I have to invest in, A or B? Definitely I have to invest in A because I will buy the stock from the market by just only 120. And if the company bankrupt, I will receive 240. We have many companies in Egypt, they have the same situation. They have a very low value on the market, and because they have a huge land, like العربية في حديق الأقطان, many companies, they have a huge land and they have a very low price. Even شركات الأسمنت الحاجات دي كلها عندهم book value عالي. Okay, so we have to take or we have to invest in the company with a low market value to book value. Now, from this two ratio alone, you can take a very good decision to invest in the stock market. Please highly concentrate. We have a very famous broker around the whole world. His name Benjamin Graham. Graham, he has equation, formula, and he use it, and he make a lot of money by this two ratio only, the BE and the market value to book value. What he said, Graham? Graham, he said that the fair value he calculate القيمة العادلة السهم ده يساوي كام. Graham, he used a two fixed number. He used a 15 to mention, according to Graham, he considers that the BE, it has to be around 15. And also, he considers that the market value divided to book value, it has to be around 1.5. So, you have to know for yourself that this 15 belongs to the BE ratio, 1.5 is belong to market value to book value. And Graham, he said, you have to take these two numbers, multiply earning per share, and multiply by the book value under the rule. If you calculate this one, you get the fair value of the stock. This is a very nice formula, and you can use it for yourself, and even you can sell it to any broker. Example. Assume you have information that the earning per share for a company, earning per share equal 4, and the book value equal 9. And if you know that the market value of the stock is 20, should we buy this stock or should we sell it؟ بالعربي، انت دلوقتي في السوق وعاوز تقدم نصيحة لمستثمر، او انت ذاتك بتدير بورتفوليو وعاوز تستثمر، عينك على حاجتين، شوف لي الايرنينج بير شير وشوف لي القيمة الدفترية كام. ايرنينج بير شير كان فوق، ربحية السهم 4 والبوك فاليو 4، ودي متوفرة تقدر توصلها بسهولة جدا. واحنا بنطالب البورصة انها تنشرهم، مش بس ان احنا نروح نشتري المعلومات دي. والسهم ده بيتباع في السوق ب20، اشتري السهم ده ولا ما اشتريهوش؟ تعمل ايه؟ طبق المعادله. يبقى الفاليو او الفير فاليو، الفير القيمه العادله، السهم ده بحلال ربنا يساوي كام؟ 15 times 1.5 times 4 times 9 under the square root طلع $28.5. ركز بقى معايا، السهم ده بحلال ربنا يساوي 28.5، هو بيتباع في السوق بكام؟ ب20. يبقى ايه الريكومنديشن؟ باي ولا سيل؟ يبقى I have to buy because by time the price أو the stock price will increase to reach 28.5. If the market price equal 50, I have to buy or sell? I have to sell. Okay? Graham formula, one of the tools we can use it to calculate the fair value. Okay? So today, alhamdulillah, we finished everything related to the financial ratios. Inshallah, my colleagues, Khalid, Osama, Muhammad, they will solve a lot of problems related to the financial ratio to be expert for financial analysis. And if you understand well, you can make a new business card for yourself and you can write that you are financial analyst. Okay? See you inshallah next lecture.